Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about FHA loan delinquencies and the risks they pose to the housing market. Before we dive in, I want to say thank you to our sponsor, Optimal Blue, for making this episode possible. Logan, welcome back to the podcast.
It is wonderful to be here, Sarah. It's going to be a very fun-filled day. We have new home sales coming out very shortly. Got to go on CNBC right after that report and talk about the builders and like we talked about since the start, before the year even started, the wild card for the economy before tariffs and everything else happened. By the way, tariffs on, tariffs off, high reciprocal percentages, low reciprocal percentages. I encourage everyone to go back to our November 7th podcast, and pretty much a lot of the things that are happening now shouldn't be surprising, but it's going to be a very interesting 4 years.
It is indeed. Okay, well, let's talk about something that I've been hearing about for a couple months. You hear all the time on social, and it's a concern people have over FHA and FHA delinquencies. Specifically, are we about to see a big crash in those loans?
Here's the thing. Mark Zandi, who's a well-known economist, probably a little bit more on the progressive side, came out yesterday and said, well, even though FHA loans aren't that big as a percentage in most of the loans in America, I think the latest data from ICE, even accounting for the FHA delinquencies, it's 3.53%. We're still about 32 basis points below the 2019 levels. Is that the housing bubble 2.0? Is this lot of professional grifters, especially men? There's a lot of men out there who just like throw out hope. Sarah, you know why I want to debate these people? Because once you get a man and you force a man to write their name and they have to show their face, like all these scrub people running around hiding behind goofy accounts, when a real man has to actually write their name down and their children and their wife and their spouse, I mean, everyone has to see it. Then you ask them for their models, it's over. And then every time that guy speaks, everyone knows, clown. It's not serious, right? But Mark Zandi is a very well-known economist, and he upped his recession forecast because he said there's credit stress. Now, we've seen credit stress in the data for some time now. Credit card delinquencies, auto loan delinquencies. We kind of, when you break down the data, a lot of renter financial profiles, a lot of single households out there. But the economy is still expanding. I mean, it's been like, what, two and a half years now that we've been talking about credit stress. We always said the Fed doesn't really care about this. It's weird to say that, but they look at the credit stress as a non-event as long as the middle class and the upper middle class are consuming goods and services, then they have to be worried more about balancing the economy. So the whole labor over inflation thing. But Mark said that this is a canary in the coal mine. I would label it this way. Obviously, those who've known me since 20, I am super conservative on lending. I even wrote back in 2012 and 2013 that FHA should raise its down payment. I would love to see FHA take a fully qualified mortgage mindset into their underwriting, but it's really designed for kind of the lower quality credit. Now, the scale of loans that have been done over the last 14 years, it's really households that are really good. And it's like the exact opposite of what the run-up from 2005 to 2008 is. But the question is, is this going to break the economy? And a lot of the people that are very advocate of highlighting the FHA delinquencies are mostly what I would say anti-central bank people or anti-government, and they believe that the government has propped up housing. In theory, the government, if you took the government out of the equation, the economy wouldn't be functional. The public and private sector have always worked together in America post World War II, and that's typically why you have inflation always, right? The economy grows, population grows. That's an inflationary economy. A deflationary economy is an economy that does not have demand, too much supply, like China. China's economy has been a mess. They have so much capacity and not enough demand. It's, in a sense, a deflationary environment. But is FHA really the housing bubble 2.0 that some people have been talking about, because I see this, people, God, every day people send me this stuff, and I'm like, there's 51 million loans here, and that's not it. So number one, always remember there's 1 to 4% of some type of stress in all delinquency data. This is why we like to show those total balance delinquencies, so you could kind of see it never goes to zero. It's like jobless claims. Jobless claims never goes to zero. Unemployment doesn't go to zero, right? There's a natural progression of people losing their jobs or being in some form of stress. Credit card stress, auto loan delinquencies, all these things are at elevated levels, but the economy is still expanding. So was it correct for Mark Zandi to up his recession percentage? By the way, we despise recession percentages. We don't believe that's a very useful concept, but the mythical 40% is coming. He upped it to 35%. So we're going to go into the structural dynamics of, is FHA the housing bubble 2.0?
Okay, so let's start first with what you said about the percentage and that we're not even at 2019 levels. At what point would you start to worry?
So basically, if we're talking about a structural systemic risk to the entire American economy, by the way, if that was going to be the case, there'd be things done. We've always highlighted what we saw in the past. 2005, 2006, 2007, and 2008, foreclosures and bankruptcies were rising for years. Then the job loss recession happened. But back then, we had a massive credit sales boom. Like, it was unbelievable. Adjusting to inflation, like mortgage debt just exploded. None of that's happening. None of that. It's been happening for 14 years. So I can't compare that period to this period because we never had a credit or sales boom. Also, if you're worried about systemic risk of major underwater homes or people selling their homes for losses and foreclosures and bankruptcies where people's lives are going to be a hit structurally for 7 to 10 years, you'd probably need a very high percentage of underwater. Oh, wait. It was 23% plus back then. It's under 2% now. So that's not a concern. The loan to values back then in 2008, when we saw this massive credit stress buildup, 85%, 46.6 now. Don't have the math. So I'm not worried about that. All the housing bubble 2.0 people are the same housing bubble 2.0. It's the anti-central bank movement people. But late cycle lending, oh, you have my blessing on that. So how I have always described FHA is basically similar to how Mark Calabrio. When you get late in a cycle, you tend to push credit a little bit more aggressively, right? Because you're trying to create more business. Late cycle lending risk to me is always going to be an FHA story. So in that process, you're already seeing credit stress build up as a percentage, like as a total percentage, it's very small. But in this category, those households, a lot of people say that the loan modifications is inflating home prices, that if the government has stayed out of this home price, that's silly. It's not that big of a percentage of homes out there. But for these households, when you go into a job loss recession, and a lot of people say, how do you have like 110 LTVs or 125% LTVs? Well, imagine you had an FHA loan. You don't have a very big down payment. You have the upfront mortgage insurance embedded into the loan. Then you have a solar panel loan or construction loan. Your LTV is high. Those households will always be at risk of a foreclosure because they do not have the nested equity. And when that happens, when you get into the foreclosure process, it's going to be a while, right? We always say minimum 9 to 18 months. If you're trying to filtrate in inventory data, you have to use that correct model. Very few people do that. But those households, I would say, are at risk. And once you get a foreclosure, you're talking years and years that your credit is going to get hit. So late cycle lending risk, you have my 100% blessing. We wrote that article in 2023 where we're telling people we should abolish the 0% neighborhood loan financing. Like, just take it away. Don't let it happen. in that. So make that the case. Don't go into the housing bubble 2.0 nonsense. I mean, that's just you just don't have the scale there. So in that context, I think the late cycle lending is a very, very sensible way to talk about it. The housing bubble 2.0, or the government is, without the government, we never did these loan modification home prices. It's just stupid. It's silly. It's not sophisticated. It's not educated. It's not talented. It's fanatical. That's not how it works. The scale of loans is very small. But for those households, late cycle lending risk has always been there. And this is my fight for the last 13, 14 years. Lending in America is not tight. As long as FHA is alive and breathing, that is a very, very liberal lending standards, to get very high debt to income ratios, to get very low down payments. It's there. It's not a very big portion of the loans, but that is a legitimate risk. So Mark Zandi put his recession risk a little bit higher just because of that. I would argue that if you're seeing credit risk happen for those households, imagine what it's going to look like when the job loss recession happens. That is a legitimate discussion. Move it into that area than trying to make the credit boom and bust, of the 2002 to 2011 housing market.
Okay, well, let's move it into that area. Okay, what does it look like? We have this late cycle risk. We have potential job losses coming. We do have a lot of uncertainty, tariffs on, tariffs off, whatever you want to say there. But apart from that, I mean, we were already, slowing down in some ways. So let's talk about that. Let's talk about your recession mindset right now.
So we've always, it's interesting. When Mark Zandi brought that tweet out, guess what I did, Sarah? Could you imagine what I did?
I know what you did.
I basically retweeted him and said, I've got a better housing indicator, recessionary indicator, and this is a little bit more efficient, and it's residential construction workers. And we're sitting here in 2025, the recession hasn't happened, and look, it's the one data line that hasn't broken yet. So, listen, there could in theory be a job loss recession without residential construction workers being laid off. And I could create a bunch of hypothetical backdrops for that to happen. But so far, manufacturing that has not broken. So we are on watch. But until we see some of the labor triggers, that jobless claims, we don't want to go into the kind of the R word, right? Because you don't want to be that person. And what's happened in the last few years is you had a lot of people who just screamed recession, 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 and it didn't happen. And they're doubling and tripling, quadrupling down. And then it's not the case. We have models, we have history models, we track these things because recessionary data is actually not that difficult to see, but you need the labor trigger. So I'm not there, right? I don't want to even go there. Also, the 10-year yield would be like, the bond market has always tried to get ahead of the Fed on things. So we're not there yet. And as all of you can see, a month ago, we talked about this is a very tough level, like 415, 418 to break. The labor data has not broken in the data lines yet. So the bond market is still up here, but not there on the recession. But if we wanted to make a late cycle lending, housing, FHA thing risk, I implore everyone, you're going to see it in the new listings data. Forget what every person says out there. If they do not have access to new listings data and give you a historical perspective, then they are not housing analysts. They are not economists. They are stock traders or YouTubers or TikTokers or, oh God, I've seen them all. So when we see stress in the data lines, like we saw in 2008 to 2012, new listings data, vertical. Why? Because those homes in scale. So forget about delinquencies. If you're thinking about supply, you'll see it in the new listings data and it will continuously go up because you're working from such low levels. The tracker data was very good in this. New listings data slow down just a smidge, but I'm not that far away from getting my 80,000. We don't see the stressed sellers that we saw back during the housing. And that's it. All you have to do is focus on the new listings data because it's It's actually a tangible variable that actually means something because that's an actual home coming to the marketplace. We take the existing home sales report, the NAR's total active listing 1.24 million, normal 2 to 2.5 million, not showing it there. New listings data, we're just trying to get back to a normal 80 to 110,000 during the peaks. We're getting there, but if you're thinking about FHA, think late cycle lending, then you want to focus on the new listings data, and then the active inventory. We're quite don't have that scale yet. And always remember, you start the process from a 30-day late. If that goes throughout, it's minimum 9 to 18 months before that happens. So if you wanted to say the government's going to take away all the loan modification process from FHA, still it has to be like 9 to 18 months of foreclosure process, new listings data, then you go with that. Okay. And just remember that the scale of the loans, right, have a lot of equity in them because the scale of the loans, it can't be a housing bubble 2.0 things because if you had 20, 30, 40, 50% equity in your house, you don't necessarily can sell your house for a foreclosure when you have that kind of nested equity.
Okay, so that brings up the part that people feel like part of the way that this is sort of being hidden or is not completely obvious is because those people who are in that cycle, they keep going back into a loan modification cycle. So if we didn't have that sort of overlay on it, we would see the data and
it's still too small.
It's being hidden.
It's way too small if you're trying to compare it to the housing bubble 2.0. But again, even with the delinquencies of FHA, we're still 32 basis points. I mean, I would tell you that one of my calls during COVID is that the foreclosure bankruptcy data would trend back to pre-COVID levels. That hasn't happened yet. So I can make a case that this is part of that. It's still too small. If you want to focus on that household, it's just not big enough to take the big scale. And this is why the Federal Reserve doesn't really look at this in that fashion. But for those households, yes, you would start necessarily the foreclosure process on that. And especially if they don't have any selling equity or their LTVs are above 100%, that's a foreclosure risk. That is a late cycle lending foreclosure risk. That makes sense. That's perfectly normal. You don't have to do the housing bubble 2.0. You don't have to say home prices nationally are inflated because it's very, very small percentage of stress. You'll see it in the data so easily. Like when it happens, let's just say we're going to have a massive wave of stressed loans and sellers coming in. It'll be so evident in the data like it was back then. It's just not here. So late cycle risk, yes, small. It's just 51 million loans out there. The general housing financial profiles of homeowners look unbelievable good. And we always say that a lot of people say, well, there's FICO score inflation. That's nonsense. The FICO score data has literally stayed the same for 14 years. Like it changed, and there was no massive improvement for homeowners. For renters, you could say it, but the scale data think about this, something has been consistent for 14 years. Why? Because qualified mortgage took that. Now, do you have that for the FHA loans? No, but the scale of the loans, the things that actually matter, and I would argue that's what the Federal Reserve would tell you, that we're seeing stress in households that we don't think are that important to the general economy. Because if we did, we would be a little bit more dovish. Where we always say that the Fed doesn't care about the credit stress until the labor market breaks. When the labor market breaks, then they're going to go, oh my God, I go to see it happening. But I think when you get a job loss recession, you're going to see those things pick up a little bit more because you're going to have more people unemployed. So if you have credit risk already, but in general households, not that big of a story.
So if I'm out here and I'm not I'm not thinking, oh, it's going to be a 2.0 housing crash 2.0, but I am worried about that late cycle lending risk. What does that mean to our industry? Like, just say, oh, you're like, yeah, that is something that you could conceivably be worried about. What's the effect if you're out there and you're a lender and you're a real estate agent? What effect does that have on you?
Well, if you are, in a sense, I mean, technically, if you give a loan to a high risk FHA and it comes back, as a delinquent in a very short amount of time, the government, which I think is going to happen, is going to start taking a little bit more careful look at the percentage of loans that go into delinquencies if you're tied to a certain bank. So if you're a lender that's really pushing FHA loans the last 2 years, and you're really pushing the debt to income ratios, you're in the future. I think they're going to be a little bit more mindful of, hey, listen, this is your loans have a very high percentage of, so what I could see happening is credit restriction coming back, or credit getting tighter with FHA lending. So if you're in the real estate or mortgage space, in the future, you can get more credit tightening. For example, they could say, we're not going to do any more loans with above 43% debt to income ratio. That is something that could possibly happen in the future. Something like that can be material to somebody in the industry if you're leveraged to very high above qualified mortgage debt to income ratios out there. But outside of that, in the scale terms, if mortgage rates fell 1%, we'd be talking about mortgage rates and housing demand picking up. That's why you have to be mindful of the scale data. And we always say that the 1980s early recession, right? Home sales crashed, recession happened, inventory was so much higher than what is right now, but mortgage rates fell 2.5%. Housing demand picked up.
Yeah.
We even with we had a back-to-back recessions in a very short amount of time. Rates fell, demand picked up, home sales went up. That would be more of the bigger story. But in this context, if you're tied to FHA lending and you're doing very high debt to income loans, you could see the government say, "Hey, listen, this is not working for us." That's something down the line. Late cycle lending and credit restriction is a legitimate story. One of the reasons why I didn't want the GSEs to leave conservatorship is that if they're publicly traded companies, credit can get tight, right? If there's no backing by the government, I still think even if they pull this off, there's going to be a backing from the Treasury. But credit can get tighter. That means everyone in the industry, you get less credit availability. That is a legitimate discussion to have.
That is a legitimate discussion to have. Okay. Anything else you wanted to talk about that with the recession?
Just the tracker. It's the first time on our weekly tracker data how I show it. I have the monthly, weekly tracker. You could see the demand pickup, but if I shorten it to just the week-to-week data, it's positive year over year. So with everything that we know now, mortgage rates still above 6.64%. The curve is slightly positive. It's nothing spectacular. It's like barely, but if it shows you if mortgage rates fell towards 6%, you could grow sales. For us to have that here, which we didn't have last year, to me, it's just like you found that bottom. We've talked about this for many, many years. There's just this 4 million level that is always held post 1996. It doesn't really break below. You can have some monthly sales below it. You can have some monthly sales above it, but it basically is held the last 2 years. But if you're showing forward-looking data that's positive year over year now, with rates still above 6.64%, imagine what happens. Hypothetical, let's just say 5.75 to 6.25, 12 months. Sales are rising. Isn't going to be great, isn't going to be spectacular, but sales can grow, right? And this is why I say this period in time reminds me a lot of the early 1980s. Inventory growth good. New listings data is good. I'm going to get my 80K. If I don't get my 80K this year, but it was a very positive weekend for the tracker. And you have to remember that you don't fall into the trap that, oh my God, supply is rising, right? Everything's terrible. Supply is at an unnatural level, right? This is why the whole team higher rates, savagely unhealthy. We have to get something back to normal. Normal is a positive because price growth is cooling down. Price growth cooling down, positive. The housing market has to be here for a very, very long time. And what I'm seeing in 2024 and 2025 for the first time in a while, I not unhealthy, right? Not savagely unhealthy. This is the way it should look out there. And if rates do fall, housing demand picks up. We're in a much better spot to handle that at this stage. I just don't think we have pro-growth monetary policies as for many, many years, the Federal Reserve has kind of just threw the housing market away and focused on other things. But when that time does come, we're in a much better spot.
I love it. And I would tell all our listeners, if you want more information, Logan goes through 8, 9, 10 different data lines every weekend on the Housing Market Tracker. And you can find it at HousingWire Housing Market Tracker on the Housing Market.
The tracker is designed to keep everybody in a sanity world, and weekly inventory, new listings data, price cut percentages, 10-year yield, purchase application data, pending contracts, what's going on with the economic data in the following week. We keep everyone in line to the real world, because out there, y'all are crazy. Y'all some crazy people out there. So, and it's a crazy world already. Like, we got a lot of crazy stuff going on, but out there, this way, if everybody Sarah, if people
I know.
Right? A
Everybody
society
reads.
like the Dark Ages, man, you couldn't even like draw something on the sand. Like they kill you for that. But if a country, if a civilization, if humans read, and then they're like, oh, that's what the data is, then you don't get, you don't fall into the trap of fanatics. And this is the history of human civilization, thousands of years, going back to the Peloponnesian War. There's always been demagogues and people who just try to focus on people who don't read. And our job is to teach, right? And it's just the most beautiful thing, a society reading and seeing data and everything. I know a lot of people love to do that, but if you look at it in that light, then fanatics kind of go to the side.
It's true. I'm so glad we got a Peloponnesian War reference in this podcast. It's been, I don't know, it's been like a week since I heard the Peloponnesian War. I needed it.
Yeah, one day we'll do a whole podcast on the Peloponnesian War. That'll be fun.
We'll do. Yes, let's do it. I'll have to do some reading. Logan, thanks so much for joining us. I will see you on CNBC here in a little bit, but thanks for being on, and I'll talk to you again soon.
My pleasure.